is a quick review question to test how well you remember some of the stuff from the last class. So this is the first question on those review questions that I post online, I believe. So for each of the following pairs, I want you to tell me which bond would you would expect to pay the higher interest rate, and explain why. And by explain, I mean no more than like one sentence, okay? A bond of the US government or a bond of an Eastern European government. Which would you expect to pay the higher interest rate? John? Why? Credit risk, right? As US government bonds are widely regarded as the safest sovereign bonds in the world. And so they're going to have lower yields than other countries' bonds because of differences in credit risk. Perfect. A bond that repays the principal in year 2025 or a bond that repays the principal in year 2040? Which would you expect to have the higher interest rate or yield? And why? Matt? Why? Yes, so bonds that have a longer term to maturity usually have higher interest rates because there are various forms of risk associated with holding an asset for a longer duration. One of them would be inflation risk. Another would be interest rate risk, which is what I talked about in the last class. So yeah, shorter term bonds tend to have lower interest rates. Longer term bonds have higher interest rates.
Yeah, ours is 80 full credit, 79 0.
How can I, okay. What do I do? Hit mute all and then yes, or do I don't remember how to do this. Uncheck it and then click yes. All right. Sorry, folks, I'm muting all of you because you haven't turned off your mics. All right, how about C? A bond from Coca-Cola or a bond from a software company that you run out of your garage. Which one would have the higher interest rate, you think? Anybody from this side of the room want to take a stab at it? No? Matt? I agree. Why? Presuming that you could actually, Matt, if you ran a company out of your garage, you'd actually even be able to sell bonds in the first place. But yeah, they would probably have higher interest rates. And why is that? Credit risk, right? Same thing as part A. A bond issued by the federal government or a bond issued by New York State. And let's assume all else equal here, that we'll assume that the US government and New York State both have the same credit risk. I don't know if that's true, but we'll just make that assumption for this question. Which would you expect to have the lower interest rate or yield? This state bond or one issued by the federal government? Yes, fifth row or so. Do you think the federal government bond would have the lower interest rate? Or have the higher interest rate, sorry. And why is that? It's the tax treatment, right? The differential tax treatment. So state bonds are examples of municipal bonds whose interest is not eligible, or you don't have to pay federal income taxes on interest on municipal bonds. And so that raises their effective interest rates, which is going to tend to push down their yields. Okay. Very good. Let's go back then to the slides, and the goal today will be to finish up the material in this section on the financial system. The main task being to develop a model of something called the market for loanable funds today that we can use to answer a couple of interesting policy questions about. Okay, I think this is where we left off in the last class. I think one of the last things we did was talk about the differences between deficits and debt. And I showed you guys a picture of this US debt clock, which shows that the United States has accumulated trillions and trillions and trillions of dollars worth of debt over its long history. So to kind of pick up where we left off last time then, we spent the last class talking in great detail about the various institutions that comprise the financial system: bonds, bond markets, stock markets, commercial banks, mutual funds. And then we spent some time towards the end of class discussing some of the key macroeconomic variables that measure activity in the financial system. In particular, different types of saving, right? And we discussed two different types. There was private saving, and there was also public or government saving, right? And we talked about government saving in the context of budget deficits and surpluses. All right, so let me move on then to the next idea here, which is national saving. So if we combine both types of saving that we talked about in the last class, private saving and government or public saving together, that gives us I guess a third measure of overall savings for the economy called national savings. It's just the sum of these two that we've talked about. So private savings, Y minus T, or taxes minus consumption, plus public saving is taxes minus government spending. If you guys add those two concepts together, you can see quickly that the tax variables should cancel out of that equation, right? You have a minus T here and a plus T here, and you're going to be left with national income, or GDP, Y, minus consumption minus government spending. Well, that's what national income is. It's just the portion of our total nation's resources or income or output that is left over after we have used it to purchase consumption goods by households as well as governments, right? So after the government spends on goods and services, and after households spend on consumption goods and services, whatever's left over out of our nation's income is what we refer to as national saving. Okay, so we've talked about the savings side of the financial system. I want to relate this to the investment side of the financial system. And the easiest place to start is with this national income accounting identity that was introduced in an earlier chapter, which defines our nation's income, or GDP, as the sum of consumption, investment, government spending, and net exports. All right, for this chapter in the course, we're going to make an assumption that the economy is closed, or at least that exports are equal to imports. And so we're going to get rid of net exports then from this equation. All right, and so that means that our economy's income is just the sum of consumption, investment, and government spending. It's very straightforward to rearrange this basic accounting identity in a way that tells us something about the financial system. All right, if you subtract consumption and government spending from both sides of the equation, and therefore solve for investment, what do you get? You get that investment is equal to Y minus C minus G. Now, hopefully you recognize the right-hand side concept now, or quantity. What is that? That's just national savings, right? It's private savings plus public saving or government saving. So by assuming a closed economy, by just getting rid of net exports for a moment, and by the way, later on in the semester, we're going to stick it back into the equation when we talk about open economy concepts. So we're not ignoring it forever. You can rearrange this GDP equation to show us that investment for the overall economy has to be equal to the economy's national savings. That's kind of the main point from that equation, right? And I think this is pretty straightforward to interpret. Hopefully you guys can see how this connects to what we talked about in the last class. if national savings is equal to total investment for our economy, then what that's saying is that every dollar that is deposited or injected into the financial system, right, deposited in banks or used to purchase stocks or bonds or mutual fund shares, has to be matched dollar for dollar by everything that is withdrawn or borrowed from the financial system for the purpose of investment. That for the economy overall, savings must balance investment. This, if you want to think about it, is really nothing more than kind of a macroeconomic generalization of that little example that we did at the beginning of the last class, where Sean was going to, I think, Sean, you were going to drop out of college and open up your own boxing gym, right? Matt was going to provide you with the startup capital you needed to finance that gym, right? In that little example, Matt's savings directly financed Sean's investment in capital spending. What this equation says is that principle must also hold at the macroeconomic level as well. That something is happening in our financial system whereby every dollar of savings is ultimately being matched by every dollar of investment in our economy. Okay, quick exercise here to kind of test your understanding of this. So let's suppose that I tell you that GDP is 10 trillion, consumption is 6.5 trillion, the government spends 2 trillion, but also runs a budget deficit of 300 billion, or $0.3 trillion. Can you calculate for me public saving, taxes, private saving, national saving, and investment? I'll just give this one away for you. So there will be a question on your exam of some variety that essentially asks you to apply your understanding of these accounting identities, to understand what national savings is and what private and public savings are, and how they relate to things like GDP, consumption, and budget deficits, etc. So this is a good question to practice that. All right. Okay, so GDP is 10 trillion, consumption is 6.5, government spending is 2, and there was a $300 billion budget deficit, meaning that G minus T is 0.3 if we scale everything or represent everything in trillions, okay? The first question, what was public saving? Can we compute public saving? Well, what is public saving equal to? It's taxes minus government spending, right? So if I tell you that the budget deficit is 0.3 trillion, then that means that public saving is just negative 0.3 trillion, right? So that one's really easy to do. Remember, public saving is just the negative of the budget deficit. What about, what was the next one? Taxes. Well, that should be straightforward, right? If you know what public saving is, and you also know what government spending is, it's 2 trillion, you can figure out what taxes are from that equation, right? T is just G minus 0.3. And so taxes, net of transfers in this problem, are $1.7 trillion. Hopefully that's clear. If the government is spending 2 trillion and taxes are 1.7 trillion, then its budget deficit is 0.3 trillion. What is private saving? Private saving is GDP minus taxes minus consumption. It's disposable income minus private consumption. So that's 10 trillion minus 1.7 trillion that we just found from the previous step, minus 6.5 trillion that's given in the problem. So I think if I calculated that right, it would be $1.8 trillion for private savings. What about national saving? National saving is public saving plus private saving. Or alternatively, it's Y minus C minus G. So 10 trillion minus 6.5 trillion minus 2 trillion gives us 1.5. What is investment then? This is the easiest one of them all. If national saving is 1.5 trillion, what must investment be? 1.5 trillion, right? Because national saving has to be equal to investment. So practice those identities. Just know the definition of private savings and public or government savings. And I'll probably ask you some question on your exam where I give you a certain information, like in this problem, and ask you to solve for something that's unknown. Or I could give you the levels of national saving and kind of ask you to work backwards, right? Either way. Okay, questions about that? All right, so before we lay out an explicit model of the financial system, I think it's important to understand the sometimes confusing distinction between saving and investment. Lots of people sometimes use these terms casually. They use them interchangeably sometimes. But to an economist, there's a real crucial distinction between saving and investment that's going to help us develop this model of the financial system that we're going to do in just a minute. First off, what is private savings? Whenever your disposable income exceeds what you're spending on consumption, then you're engaged in private saving. If your income is greater than your own consumption spending, then whatever you do with the leftover resources there is what we call private savings, okay? There are some easy examples of activities that are regarded as savings. If you were to buy a corporate bond or a stock, you're engaged in saving. If you purchase a bank certificate of deposit, you are saving rather than consuming. If you buy shares of a mutual fund, or you simply let your checking account or savings account balance accumulate over time, you are engaged in saving, all right? Saving simply means that you are electing to not consume today in favor of consuming more tomorrow, or a month from now, or a year from now. So the reason I bring this up is that many people, for instance, talk about investing in equities or investing in the bond market, okay? Just be careful about that language in your economics class. You might think of yourself as investing your money, but really what you're doing is you're engaged in a form of savings, okay? Now, what is investment? Investment is the actual purchase of new capital goods. When resources are used to purchase or create new capital goods, whether it be equipment or structures or research and development, whatever type of investment good it is, that is investment spending rather than savings. Okay, so some quick examples of what we mean by investment. If General Motors spends $250 million to build a brand new factory in Flint, Michigan, that's an example of a non-residential investment. If you buy $5,000 worth of computer equipment for your business, that is an investment in equipment for a private business. If you or your parents spend $300,000 to have a new home built, that is investment spending, right? Remember, investment is not just equipment, but it's structures, both non-residential and residential structures. These are all examples of investment rather than savings, okay? Remember, in economics, investment is not the purchase of stocks and bonds. A company might raise funds by issuing stocks, selling stocks, and once that company collects those funds, it can then use them to purchase new capital equipment. That is investment. but simply someone purchasing a stock or purchasing a bond is actually considered a form of savings. Okay. All right, so having now discussed all of the major financial institutions in our economy, as well as these key kind of macroeconomic variables that measure activity in the financial system, like national saving and private and government savings, I think we're now ready to start to actually put together a formal economic model of the financial system, all right? Now, the model that we are going to develop, I think, is very straightforward and easy to understand because it's nothing more than an application of basic supply and demand principles to the financial system, okay? Now, in building this model, we have kind of two goals in mind. And I want you to think about these goals as we're working through the various pieces of the model and looking at some applications of it. The first thing that we want to try to accomplish is to explain how exactly the financial system coordinates saving with investment. One thing that I hope you guys understand at this point is that for our economy as a whole, savings must balance investment. But how exactly that happens, what mechanism in our economy is doing the work of trying to balance the efforts of savers with those who want to make productive investment purchases, how that actually plays out, how that works in our economy. Well, the model is going to hopefully shed some light on how exactly that mechanism works. What is it that's actually balancing the wants of savers with the needs of investors? How is that coordinated in our economy? That's one thing that the model is going to do. The other thing, the other reason why we want to develop a model of the financial system is because ultimately we would like to use it to examine how different types of government policies might actually affect things like national savings or investment or interest rates. These kinds of questions you can't answer with any real certainty unless you actually are working with kind of a formal, articulated model of the economy, right? We need to look at something like the solo growth model to answer how policies might affect living standards in the long run. But if I want to know how certain types of government policies might affect people's savings and investment decisions and how it might affect interest rates, we need to kind of view that problem through the lens of a model of the financial system, all right? So that's the other reason why we want to develop this particular model. Okay, in developing this supply and demand framework for the financial system, we're going to make two key simplifying assumptions, all right? The real financial system, of course, is terribly complicated. But we're going to try to simplify it down to something that is easy to understand for a principles class, all right? The first assumption that we're going to make is that our economy is only going to be assumed to have one financial market, okay? And that is something called the market for loanable funds. Now, we just got done talking about how there's bond markets and stock markets, et cetera, okay? We're going to abstract from all of that complexity and just assume that there's only one financial market in our economy, and that's the market for something called loanable funds. Now, what is that exactly? What are loanable funds? Well, these are just defined as the income that people have chosen to save rather than consume. Okay, the income that people and potentially governments have chosen to save rather than consume. These are going to be the goods that are essentially traded in our supply and demand model, okay? All savers in our economy are going to go to this one financial market to deposit their savings. So anybody who's interested in saving for the future deposits their income in this one market for loanable funds. Any investor who wants to borrow to purchase new capital goods has to acquire loans from this single financial market, this market for loanable funds. The second assumption really follows from the first one, and that is because there's only one financial market here, we're going to assume that there's only one interest rate. All right? Now, that interest rate is obviously going to be or reflect the return that savers get on their saving, but the interest rate is also going to represent the cost of borrowing for investors. There are obviously many interest rates in our economy, each of them attached to a variety of different financial instruments, okay? But I think that the supply and demand concept can be generalized to any number of different types of financial markets. So I think we can still learn a lot about the financial system by just focusing on a single market, this market for so-called loanable funds. Okay, the market for loanable funds, I'm going to argue, is like most other markets in that it's governed basically by the laws of supply and demand. Okay, so let's start piecing together the parts of this model by looking first at the supply of loanable funds. Now, where exactly does the supply of loanable funds in this financial market come from? Where can we trace the source of the supply of loanable funds? Well, to savings, right? Well, in our economy, there's two sources of savings, right? There are households that have extra income that can potentially loan out that savings to earn some positive interest on it, right? So one key source of the supply of loanable funds, probably the main source, is going to come from private savings. What's left over of our disposable income after we've made consumption decisions. That's not the only source, however, of the supply of loanable funds in financial markets. So it's not just that private households can potentially save, but I know it might be shocking to hear this, but actually your government can potentially save as well, okay? Particularly if public saving is positive, that is, the government is running a budget surplus, then government or public savings is going to add to or contribute to the economy's supply of loanable funds, okay? If, however, public saving is negative, meaning that the government is running a budget deficit, then the government is going to effectively be draining resources or draining dollars from the potential supply of loanable funds. Okay, so that's where we trace the supply of loanable funds to, is to private household saving as well as government savings. Every dollar in our economy that gets spent on or gets deposited into a bank savings or checking account, every dollar that is used to purchase newly issued stocks or bonds or mutual funds counts towards savings that contributes to the supply of loanable funds in our economy. Okay, let's graph the supply curve then in this particular model. So as you guys know, in a supply and demand model, we want to put the quantity of the good that we're talking about, which is going to be loanable funds measured in billions of US dollars here on the horizontal axis. And the variable that we want to graph on the vertical axis is the price of the good. So let me stop here. You'll notice that on this graph, I've got the interest rate as the price of loanable funds. Now, why does that make sense from the perspective of a saver, that is a supplier of loanable funds? In what way does the interest rate reflect the price of loanable funds? Well, The interest rate is the return to saving, right? It's what someone who's going to deposit their money into a bank account is going to earn by supplying resources to the financial system, okay? So the relevant price in this model is the interest rate. All right, now do you think the supply of loanable funds should be upward sloping or downward sloping? How should the interest rate be related to the quantity of funds supplied? Well, most supply curves I can think of are upward sloping, right? Now, why does that make sense? In other words, why would we expect to see an increase in the interest rate generate an increase in the quantity supplied of loanable funds? Sean? Well, now hold on. Let's not talk about demand yet. You're a potential saver, right? If your bank is quoting you a 3% interest rate on your account, then you might save some amount, right? But if they double the interest they're going to pay you, then that's going to encourage you to want to save more, right? And so collectively, all savers are encouraged to save more if the return to saving goes up. And so, Sean, you might elect to hold back or reduce some of your consumption in order to save more so that you can take advantage of those higher returns. So the supply of loanable funds is upward sloping. Let me ask you one other key question here that I don't have spelled out exactly in the slides. We talked about earlier in the semester, I think, if I'm remembering this right, there are two interest rates. There's a nominal interest rate and a real interest rate. What's the difference between those two, first of all? What's the difference between the real and nominal interest rate? The real interest rate is corrected for the effects of inflation. The real interest rate is the nominal rate minus inflation. Matt, which interest rate do you think is more relevant for people's supply decisions? The real or the nominal rate? The real rate, right? What people care about in the real world is their real return to saving, not their nominal return, right? The nominal interest rate can be 100%, but you're not going to save more if the inflation rate is 300%, right? So it's the real interest rate that matters here. So be careful about that. Maybe put a note in your slides that the interest rate that is relevant for this market is the real interest rate, not the nominal one. It's the one that's corrected for the effects of inflation. All right, let's talk about demand for just a minute or two here. If the supply of loanable funds can ultimately be traced to savers in our economy, both private savers as well as the government, where does the demand for loanable funds come from? Well, this is from individuals and mainly businesses that need resources for investment spending. So the supply of loanable funds is traced to saving. The demand for loanable funds is traced to investment, okay? There are basically two types or two sources of investment demand in our economy. Probably the most important would be firms and businesses who want to borrow so they can pay for things like new capital equipment, new factories, warehouses, R&D spending, etc. But also the private household sector demands or wants to borrow from the financial system in order to purchase new housing, right? Remember, new housing is a form of investment. It's residential investment. So both of these sources determine the demand for investment and therefore the demand for loanable funds in our economy. So in any given year, the nation's total amount of spending on things like capital equipment and warehouses and factories and new homes and apartment buildings, etc., all of that contributes to the demand for loanable funds. All right, let's put that demand curve on our loanable funds interest rate graph here, okay? Again, why does it make sense for the interest rate to reflect the price of loanable funds from the viewpoint of a demander or an investor? If a company has to borrow in order to finance spending on a new factory, the interest rate reflects the cost of borrowing, right? It's the cost that is paid in order to acquire these loanable funds. And so the interest rate is still the relevant price variable in this model. Now, the supply curve was upward sloping. The demand curve here is obviously going to be downward sloping. So as the interest rate, the real interest rate that is, falls, let's say from 7% to 4%, the quantity of loanable funds demanded is going to go up, let's say by about $30 billion here. Now let's be careful about this. Why should the demand for loanable funds be downward sloping? Ask yourself that. So it's important that you guys can use these models, but I also want you to be able to interpret them, to understand where they come from. What's the economic rationale for why the demand for loanable funds should increase as the interest rate falls? Matt? Okay, so a little bit more there. One reason is that if you are a company, Matt, that's, let's say you need to borrow in order to finance that investment, if the interest rate falls, then your borrowing costs are going to fall, and you're going to be more willing to make those investment purchases, right? So as the cost of borrowing falls, investment demand goes up. Now, Matt, let me come back to you for a second. Let me ask you guys a hypothetical question here. What if we had a company that doesn't need to borrow in order to finance the construction, let's say, of a new warehouse? The warehouse costs, I don't know, $20 million. Why would we still expect to see the following? If the interest rate goes up, that company is going to be less willing to make that investment purchase with its own cash. So it's true that as interest rates rise, the cost of borrowing goes up, and so firms are going to be less willing to borrow to purchase investment goods. But what if firms don't have to borrow? Why does it still make sense that businesses are going to want to borrow less or invest less as interest rates rise, even if they have the cash on hand, the liquidity needed to purchase these investment products? Why might we expect investment to decline anyway? Can anybody think of an economic reason as to why that might happen? Sean? Well, okay, let's think, Sean, let's suppose that you had $20 million to purchase this new warehouse for your company. What else could you do with that $20 million instead of purchasing the warehouse as interest rates rise? What's your next, think of in terms of opportunity cost. What's your next best available activity? Instead of purchasing or building the warehouse, you could do what? You could turn around and, no, you could turn around and save it. You could loan the 20 million to somebody else who has a investment project, right? And so, in other words, what's happening here is that even though Sean's company doesn't have to borrow to build the new warehouse, they could still loan those resources out to someone else who might want to. And so the opportunity cost of investment is going up as interest rates rise. That's also important to understand. Okay, let me reemphasize that because I think it's kind of a confusing point. As interest rates go up or down, the actual cost of borrowing changes. That's straightforward. But the opportunity cost of investment is also going to change as the interest rate changes. Because even if you don't have to borrow and you have the resources needed, you could always loan those resources, that is, be a saver to somebody else at a higher interest rate. Okay, we put supply and demand together. You guys understand well the concept of equilibrium. What should we see happen in this market? The interest rate, the real interest rate that is, should adjust in order to balance the supply and the demand for loanable funds, which in this little example occurs at an interest rate of 5% and a quantity of loanable funds of $60 billion. This, in a nutshell, is how the financial system or the financial market guarantees that savings balances with investment in our economy, right? Where does the supply of loanable funds come from? It comes from national savings, both private and government savings. The demand for loanable funds comes from our desire to purchase investment. The real interest rate adjusts in equilibrium to balance savings, that is the supply of loanable funds, with investment, that is the demand for loanable funds. Let's just do a hypothetical example here. What would happen if the real interest rate were up here at like 7%? Then we would have a situation where the supply or savings is greater than demand or investment. So that would be a surplus of loanable funds, right? Where you have a lot of savers competing over scarce borrowers, right? What happens if you have a bunch of savers competing over scarce borrowing? The interest rate should fall, and it'll continue to fall until you get to the equilibrium point. If the interest rate instead were, let's say, 3%, then you have the opposite scenario, right? Where the demand for loanable funds, that is investment, exceeds the supply of loanable funds, that is saving. In that case, you have a bunch of borrowers in the financial system competing over scarce lenders. If there's too many borrowers relative to lenders, then what happens to the interest rate? It's going to be bid up. And the interest rate should fluctuate until it balances the desires of savers and lenders in this market. That is, it balances savings with investment. That really is the key economic idea I want you guys to take away from this section of the course, okay? When you guys learned about supply and demand in probably your high school economics class, you hopefully discovered that the price mechanism or the price system in a free market system is the thing that balances the efforts of buyers and sellers. Okay? How do we know that supply is going to equal demand? Well, the price is going to move around until the desires of the seller balance the needs of the buyer. That's exactly what's happening in this particular market. It's just a market of the financial system, or it's a market for loanable funds. It's the real interest rate is going to be the thing that moves around in order to coordinate the efforts of savers, that is the supply, with investors, that is the demand. Okay, so what is it that ensures that national savings is going to be equal to investment? It's a freely moving real interest rate in a free market system with competitive financial markets. That's kind of what's going on here. Okay, you guys have any questions then about the model? What I want to do is spend the last 25 minutes or so working through a few examples about how we can apply this to see how different types of government policies might affect things like savings and investment and interest rates in the economy. Wyatt? Well, let's go through the examples here because I think they might answer your question. I have a couple of examples of tax cuts, but you could just do them in reverse to talk about an increase in taxes. Okay, so here's my first example I want to work together. I want you guys to, so here's a question that you might like see on an exam, okay? I want you guys to tell me how the financial system is affected. That is, what happens to savings, investment, and interest rates if there was, Wyatt, let's say a change in the tax code that allowed people to shelter more of their income from, or more of their savings rather, from taxation. So some concrete examples of what I'm talking about. Let's suppose that the government increased the maximum contributions that you could make to your 401k or your individual retirement accounts. All right, this would be a change in the tax law that incentivized people to shelter more of their savings from taxation. What are the macroeconomic implications of that? How does that affect the financial system? How does it affect national savings, investment, and interest rates? Okay, I want you guys to use this model to answer that question. So where do we start? Well, draw your downward sloping demand for loanable funds and your upward sloping supply and show me your initial equilibrium point. Label everything nicely. Make sure you have the real interest rate labeled up here on the vertical axis and the quantity of loanable funds over here on the horizontal axis. So Wyatt, let me come to you. What do you think would happen? Do you think the supply of loanable funds or the demand for loanable funds would be affected directly by this tax change? I agree, right? So this is a policy change that is designed to increase people's incentive to save. The supply of loanable funds comes from private savings and also government savings. So that's going to affect, in my opinion, the supply of loanable funds directly, not demand. Demand comes from investment. And it's likely going to increase national savings because if people can now put more resources into their retirement accounts tax-free, that's going to encourage greater saving and therefore less consumption spending, and therefore push the supply of loanable funds to the right. Now, Wyatt, what happens then in equilibrium in this loanable funds market? If the supply moves to the right, given a fixed demand schedule, in particular, what would you expect to see happen to the interest rate? It's going to fall, right? At the old interest rate of 5%, we now have the supply of loanable funds exceeding demand. You have a surplus of resources in the financial system. So you have lenders competing or chasing scarce borrowers or investors. That's going to cause the interest rate to be bid down, right? And the interest rate will decline until it reestablishes equilibrium at the new intersection point, let's say 4%, with, we'll say, $10 billion more in total loanable funds traded. So what happens to the interest rate as a result of this policy? It's going to fall. What happens to the amount of savings in our economy as a result of this tax change? It's going to increase from 60 to 70 billion. Wyatt, what happens to the amount of investment, however? If savings increases by 10 billion, then what should happen to investment spending? No, remember, savings is equal to investment in equilibrium. So if savings goes up, investment has to go up. This is a subtle but important point. Let's think about this for a minute. This policy, Wyatt, was designed to try to encourage greater savings. And it did. It shifted the supply to the right. but it has the secondary effect of also increasing investment. How does it do that? Well, as soon as people start to want to save more, that puts downward pressure on the real interest rate, right? Because it creates a surplus of savings in the financial system. And as the interest rate falls, what's going to happen then to investment demand? It's going to go up because the cost of borrowing declines, or the opportunity cost of investment is going down. So even though this policy was designed to affect savings directly, because it ultimately affects the interest rate, it's also going to increase investment, right? That's what the demand curve is. It's investment for capital goods. All right, let's do another. Again, what if I ask you, can you tell me what the effects on the financial system would be? That is, what happens to national savings, investment, and interest rates if there is a change in, let's say, the tax code that lowered one's taxable liability, provided that they use the funds to purchase new capital? So a couple of, again, concrete examples of what I'm talking about. One might be a corporate income tax credit, provided the company use the tax credit to purchase new capital goods. Another common one might be an income tax credit for new home buyers. This is something the federal government has done in the past, giving an annual tax credit to first-time home buyers. How would that policy change affect savings, investment, and interest rates? Again, just go through the steps. Does it affect the supply of loanable funds directly, or the demand for loanable funds, you think? If it is a policy designed to stimulate investment, Matt? It's probably going to affect the demand, and it'll shift the demand curve to the right. So at the same old interest rate of 5%, now the demand curve is going to be shifted out to the right. And so in this example, because the demand curve shifts instead of the supply curve, we have a situation where we've got, let's say, borrowers now competing, Matt, over scarce lenders. And so what's going to happen to the interest rate as a result of that? Going to start to rise, and it will continue to rise until it reestablishes equilibrium at, let's say, 6% and $10 billion more in loanable funds traded. Okay, so what have we discovered here? That a policy like an investment tax credit is going to ultimately increase the interest rate and increase the amount of investment spending in our economy. Matt, what happens to national savings as a result of the policy? It's going to increase, and it's going to increase ultimately by the same amount that investment goes up by, because savings has to equal investment in equilibrium. Again, this is an important point that I want to make here. Even though, Matt, this policy is designed to try to encourage greater investment spending, it ultimately has the effect of increasing savings in our economy as well. And why is that? Because as soon as people and businesses start to spend more on investment, that starts to put upward pressure on the interest rate. And as interest rates rise, your return to savings is going to go up, and it's going to encourage greater saving. So these policies have direct effects, but they also have secondary effects. In equilibrium, we know that savings has to equal investment. Let's do one more. Same type of question. What happens to savings, investment, interest rates, and therefore the financial system? But in this example, I want you guys to analyze the effects of an increase in the budget deficit. All right, so here's the scenario I want to describe. Let's suppose that we are at this equilibrium point where the interest rate is 5%. And let's also pretend for a moment that our government is currently running a balanced budget. So government spending is equal to taxes, okay? And now the government announces that they're going to implement a stimulus effort. They're going to raise government spending and also lower taxes. That means that the government is going to at least temporarily run a budget deficit. So the budget is balanced right now, but after government spending goes up and taxes go down, the government's going to be running a budget deficit. Are there any implications on that budget deficit in the market for loanable funds? What happens to interest rates, saving, and investment as a result of the fiscal policy? Step one, ask yourself whether or not the policy change affects the supply or the demand for loanable funds. Which direction do those curves shift? And then what happens in equilibrium? What do you think? Higher budget, if we start from a position of a balanced budget, if we move to a budget deficit, do you think that's going to affect the supply or the demand for loanable funds? Sean? Why? The supply of loanable funds traces to our national saving, right? That's all the dollars that are deposited into the financial system. What is national saving? Well, it's the sum of private savings and government savings, okay? The first example that we did was one that increased private saving. This third example is a case in which a higher fiscal spending actually lowers government saving. So the lower is government saving, what happens to national saving? National saving goes down, right? Remember, government deficits drain resources from national savings. And so in this case, it's going to affect the supply of loanable funds. And Sean, which direction is it going to shift? It's going to shift to the left or back or up, whichever way you want to look at it there, okay? And as a result, we are, as soon as the government starts to run these budget deficits, the model predicts that the supply is going to be less than demand. So you're going to have borrowers competing over scarce lenders now because resources are being drained from the financial system. And as a result, that's going to put upward pressure on the interest rate, right? And it'll eventually reestablish equilibrium at an interest rate of, let's say, 6% and a quantity of loanable funds equal to $50 billion. Okay, now, to kind of summarize what has happened here in this example, what the analysis shows is that an increase in the budget deficit causes a fall in private investment. Now, why does that happen? Why is there also, so there's a reduction in national savings because of the budget deficit, but why does it ultimately lower private investment? Matt? Investment is total savings, but the higher deficit reduces savings, but what is the mechanism that actually causes investment to decline as well? There's a rise in the real interest rate, right? Once these resources start to get drained from the financial system, there's less supply in the market, that causes the real interest rate to go up, okay? And as a result, as the real interest rates rise, this increases the cost of borrowing or increases the opportunity cost of investment and causes private investment to decline. Some economists refer to this as the crowding out effect. Okay, it's one of the major reasons why, I'm not going to say every economist, but a certain portion of macroeconomists argue heavily against running large and persistent budget deficits, is that because over time it's going to risk raising interest rates and therefore crowding out private investment. okay? You might even recall from the last couple of chapters on long-run economic growth that investment in capital was important to increase worker productivity and raise living standards in the long run, right? And so one argument against having these persistent and high budget deficits is that it's going to reduce the capital stock in the long run, make workers less productive, and therefore reduce living standards. That's not a universally accepted argument. There are some macroeconomists who don't think that budget deficits, at least currently, are going to risk doing this, and there's a variety of reasons why. I don't want to get into the details, but one thing I will say is that one assumption we've made in this setup is that we're dealing with a closed economy. Net exports are zero, right? One thing that hopefully you guys will see by the end of the semester is that when we reopen the economy, it's no longer the case that savings has to equal investment. In fact, in an open economy version of this model, it's domestic savings plus savings that we're getting in from the rest of the world that has to match our own domestic investment. So just because we're running high budget deficits here in America and our own domestic savings is low, doesn't necessarily mean investment is going to fall if we're receiving a lot of savings from abroad, which in fact we are, okay? The US economy, for a variety of reasons, is a attractor of global savings. And so that's why, for example, in the US, you see that interest rates have been really low for a long time, despite the fact that we've been running these huge budget deficits for a while. It kind of runs against this model that I've just talked about, but if you think about savings coming in from the rest of the world to supply extra dollars to our financial system, it's easier to rationalize why interest rates have stayed so low in the US economy, despite the fact that we've had these really large budget deficits for a long time. Okay, do you guys have any questions then about those examples? So kind of I think the main, to sum up here, the main ideas from this last chapter is to, one, understand what it is the financial system does. What institutions make up the financial system? Stock markets, bond markets, commercial banks, etc. And their main responsibility is to try to channel resources from savers to borrowers that have these productive investment opportunities. Okay, now the other main idea is that we tried to develop today was understanding how the heck the financial system does that. How does it coordinate the efforts of savers with investors? Well, it does so through the real interest rate. The real interest rate should adjust to balance the returns to savings with the cost of borrowing. And that's what that simple model of the loanable funds market tries to illustrate. Once you guys understand that, you can use that model to think about how different types of tax or spending policies by the government might affect things like savings, investments, and interest rates. Okay? That is all I have. So hopefully you guys will be ready by Thursday for your exam. I don't know if I've commented before, but you could expect the same type of general setup for your test. There's going to be some multiple choice questions. There's going to be a couple of these free response type questions. We've talked about two economic models really since your last exam, the solo growth model and this model of the loanable funds market, okay? So it stands to reason you guys are probably going to see some questions that ask you to apply those models in maybe a context that we haven't quite discussed in class. So make sure you review them and you understand all the different pieces and how they work in equilibrium, okay? All right, I'll see you guys on Thursday. Everybody's going to be here. No notes, no cell phones, but you can bring a calculator if you want to, okay? Hold on one sec. Let me